Welcome back to the Deep Dive. Today we're doing something pretty specific. We're skipping the usual headlines for a really close journalistic look at a stock screener report,
That's right.
focusing on three massive players in entertainment right now: Walt Disney, Warner Bros., Discovery, and Paramount Skydance Corp.
Exactly. We're going deep into the numbers, the fundamentals, the technicals, the news, basically everything driving these three specific companies.
The idea is to give you a really solid, data-driven snapshot of where things stand in this sector.
And I do need to mention just quickly, as we talk about these numbers and potential scenarios, this is all for educational and journalistic review, okay? It's based purely on the source reports we have in front of us.
Right.
It's definitely not financial advice or any kind of investment recommendation. Just want to be clear on that.
Absolutely. Good point. So what ties them together? Well, they're all U.S.-based communication services, entertainment companies, all fighting tooth and nail in the streaming and content wars.
Yeah.
But as we'll see, their financial situations, especially with all this M&A talk, well, they're actually quite different.
Very different paths they're taking.
Okay, so let's kick things off with the giant Walt Disney Company, DIS, trading around $111.
Right.
The scale is just immense. Market cap, almost $200 billion. That's 199.88 Bs to be precise. And sales over the last year, $94 billion.
Yeah, that size really gives them, a foundation, and you see it directly in the financials. This is key when you compare Disney to the others.
Oh, so?
Well, look at their profit margin, over 12%. Gross margin, almost 32%. These are really strong margins for the sector.
Much better than the peers we'll look at.
Exactly.
Rare.
It tells you that Disney isn't just about streaming. They've got the parks, the cruises, merchandise. That whole ecosystem provides a kind of financial cushion.
Ah, okay. So they're not quite as exposed to the sort of ups and downs of just the streaming subscriber numbers.
Precisely. It insulates their overall profitability quite a bit.
And the valuation. The PE ratio is about 17.4. Seems, well, not crazy high.
No, it's pretty reasonable. And the PEG ratio that compares the PE to expected growth is 1.26. Often, when that's around 1, it suggests the stock's price is kind of in line with its growth prospects.
So analysts seem to like it.
Oh, yeah. The consensus rating is 1.49. On the typical 1 to 5 scale, that's firmly in the buy territory.
And they see upside.
They do. The average target price is up around $137.50, quite a bit higher than the current $111.
Okay, that's the fundamental picture. Rock solid, seems like. What about the technicals? The stock chart? Is it as stable?
Well, not quite as smooth, actually. Over the last 6 months, performance is strong, up over 31%. That's good. But more recently, there's been some pressure. It's trading a bit below its 20-day and 50-day moving averages. That suggests some short-term weakness, maybe a little pullback.
Which some traders might see as an opportunity, I suppose.
Potentially. But the other thing to keep in mind here is the beta. It's 1.56.
And remind us what beta means, practically speaking.
Sure. Beta tells you how much a stock tends to move compared to the overall market, like the S&P 500. A beta over 1 means it's more volatile.
So Disney moves more than the market, up and down.
Yeah, roughly 56% more volatile. So if the market goes up 1%, Disney might go up 1.56%. But if the market drops, it could drop more too. It amplifies the moves.
Got it. Okay, news-wise, what's driving things? There's always something with the Disney.
Always. Well, there's the ongoing talk about who eventually replaces Bob Iger, maybe a co-CEO structure that keeps popping up.
Right.
But the big content news recently was the Taylor Swift docuseries. 6 episodes coming to Disney Plus in December.
The Eras Tour film, adapted for streaming. That's huge.
Absolutely massive. That kind of exclusive, high-profile content is exactly what drives subscriber growth and keeps people sticky.
Okay, so let's try a paper money example to see what that volatility and upside look like over the past year.
Good idea. So the stock's been between about $80 and $125 over the last 52 weeks.
That's a pretty wide range. So let's say someone hypothetically put $10,000 in at that low point, $80.10. That would get them, what, about 125 shares?
Around 124.8 shares, yeah. Now, if they manage to sell, hypothetically again, at the 52-week high of $124.69.
Okay.
The paper profit on that $10,000 would be about $5,563.
Wow, a 55.6% gain on paper.
Exactly. It really shows that even with some short-term bumps, the potential has been there, backed by that brand and financial strength.
All right, let's switch gears completely. Warner Bros., Discovery, WBD, trading much lower at around $18.
Yeah, a mid-cap player. And just a fascinating mix of signals here. It really feels like a company in transition after that huge merger.
How so? What are the numbers telling us?
Well, fundamentally, it look risky. The PE ratio is super high, almost 60. That often screams overvaluation. Or maybe it reflects some weirdness from recent earnings after the merger.
You okay?
Their debt is also high. Debt to equity is 0.96, similar level to what we'll see with Paramount. And the profit margin, tiny, just 2%.
So none of that Disney buffer you mentioned.
Not at all. They seem much more exposed, really in the thick of that costly content battle.
But the growth outlook, that's where it gets really wild, right?
Completely wild. Okay, so projected earnings per share growth this year is forecast at a huge positive 108%. Massive jump, presumably from merger synergies and turnaround efforts.
Okay, sounds good.
But then you look at the projection for next year, and it's forecasted to decline by a staggering 184.62% negative.
Whoa, wait. Negative 184%. That's dramatic. How do you even interpret that?
It's extreme volatility. It suggests the market sees maybe a short-term pop, but has serious doubts about whether that growth is sustainable long-term. That looming drop is a huge red flag.
So how are analysts rating it then, with a forecast like that?
It's basically a neutral hold. The average recommendation is 2.26, and the price target around $18.50 is barely above where it's trading now.
So it feels like the analysts are saying, we see the problems, but maybe something else happens, like M&A.
I think that's exactly what the data suggests. The technical performance, the stock price movement, seems totally detached from those worrying fundamentals. It's been driven by something else.
Which is?
Just look at the performance numbers. Up 138% over the last year. Up 124% in the last 6 months. Insane growth.
Okay, so the stock price clearly reflects anticipation of something big.
M&A speculation, almost certainly. It hasn't been trading on its earnings. It's been trading on the story of potential deals.
And that creates huge volatility, like the beta.
Exactly. The beta is even higher than Disney's at 1.74. Very volatile. And while the long-term trend has been massively up, we are seeing a recent pullback, down over 7.5% in the last month.
Right. And the big news is M&A, isn't it? They just turned down a bid.
Yep. The main story is WBD rejecting that reported $20 per share offer from Paramount Skydance.
Suggesting they think they're worth more or have other plans.
Right. And adding to the drama, you've seen recent big stock sales by their CFO and chief revenue officer.
Executives taking profits after that huge run-up.
Looks like it. Though you also had a director making a large buy back in August 25, so mixed signals from insiders.
Okay, let's do another paper money scenario. That 6-month run was incredible, 124%.
Yeah, let's illustrate that. Say a paper investor put $5,000 into WBD 6 months ago.
Okay.
Based purely on that 124.19% performance over that half year. The paper profit would be around $6,209.
More than double the initial $5,000 on paper in just 6 months.
Phenomenal return. But it highlights just how much this has been a high-risk, high-reward momentum play, completely overshadowed by those underlying financial question marks.
Okay, finally, let's talk about the company driving a lot of this M&A buzz. Paramount Skydance Corp, PSKY, smallest of the three, market cap around $18.4 billion, trading near $17.30.
And PSKY, fundamentally speaking, presents probably the most challenging picture.
How so?
Well, their earnings per share are negative, minus 3 cents per share, trailing 12 months, so you can't even calculate a meaningful PE ratio. Profit margin is also slightly negative.
Not profitable on paper right now.
Nope. And like WBD, they've got high debt. Debt to equity is 0.93. So fundamentally weak.
But there must be something attractive. Why all the M&A talk?
The main thing is likely the price to sales ratio. It's really low, just 0.64. That means you're paying relatively little for each dollar of their revenue, which can make the assets look cheap to a potential buyer.
Right, the classic sum of the parts or asset play argument. But here's a really interesting contrast. Despite those weak numbers, insider ownership is super high.
It is 20.26%. That's a big chunk held by insiders. And yeah, contrast that with the executives we saw selling at Disney and WBD.
So why would insiders hold so much if the fundamentals look weak and analysts are down on it?
Well, the analysts are definitely cautious. The recommendation is 3.52, which leans towards hold sell, and their average price target is only $12.64.
Way below the current trading price of over $17.
Exactly. So the high insider ownership, especially with names like Larry Ellison reportedly backing Skydance's bid efforts, it strongly suggests those insiders are betting heavily on an M&A outcome.
They think a deal will happen at a price much higher than where analysts value the company on its own.
That seems to be the implication. They have conviction in the deal value, not necessarily the standalone operations right now.
And technically, the stock has run up on that hope, right? Up over 65% this year.
Absolutely. Year-to-date performance is strong, again, purely on that M&A speculation. But like WBD, it's seeing recent pressure. It's trading almost 7% below its 20-day moving average right now.
Okay, and you mentioned something about short interest.
Yeah, this is important for PSKY. The short flow is high, almost 10%.
Meaning nearly 10% of the shares available to trade are being used to bet against the stock.
Correct. Traders are borrowing shares and selling them, hoping the price will fall so they can buy them back cheaper. A high short float like this adds another layer of tension.
How?
If a deal does get announced, or looks very likely, all those short sellers might panic and rush to buy back shares to close their positions. That flood of buying pressure can cause the stock price to spike up very quickly and violently. It's called a short squeeze.
Ah, okay. So high stakes for both the bulls and the bears here.
Definitely. And the news confirms PSKY is being aggressive. They're reportedly still circling WBD even after the rejection. And they did just buy the free press for $150 million, showing they're trying to build scale themselves.
We also saw some planned insider sales mentioned, like from the Redstone Trust.
Yes, proposed sales. That's pretty common when deal talk pushes the stock price up significantly. Some long-term holders might take the opportunity to diversify or lock in some gains.
Okay, so given this gap between the current price and the analyst target and all the M&A hype, let's imagine a short-selling paper scenario.
Right. Betting against that hype near the recent highs. The 52-week high was $20.86.
So if a theoretical paper trader shorted, say, $5,000 worth of PSKY right at that peak, $20.86 a share, that's about 240 shares.
Roughly 239.7 shares, yeah. Now, if they covered that short position, meaning they bought the shares back, at the current price around $17.29.
They'd profit from the price drop.
Correct. The paper profit would be about $856 on that $5,000 short position.
Okay, so it shows how the volatility, driven purely by speculation and being way above analyst targets, creates chances for traders on both sides, betting for the merger or betting against the hype.
Precisely. It's a very different dynamic than Disney, #tag outro. So tying it all together, what we're really seeing across these three is this intense race for scale and crucially profitable streaming and content. It's not just about subscribers anymore, it's about making money from them.
Right, and Disney clearly has that financial stability, that brand power, and those other businesses like parks to lean on.
Warner Bros. Discovery. Incredible momentum recently, but purely driven by M&A hopes, it seems, while facing some really daunting fundamental hurdles, especially that projected EPS cliff next year.
Yeah, that negative 184% is hard to ignore.
Very. And Paramount Skydance is the aggressive deal maker, the potential catalyst, despite having the weakest financials of the three on paper right now.
And maybe the most striking thing, as you pointed out, is the ownership story. You see executives at the big established players, Disney and WBD, selling stock, taking some profits off the table after big runs.
Right. Exercising options, selling shares. Standard stuff, but notable.
While at PSKY, the smaller, riskier aggressor, you have that really high 20% insider ownership showing strong conviction.
But at the same time, the professional analysts are the most cautious on PSKY, giving it the lowest rating and a target price way below where it's trading.
That tension is fascinating.
It really is. And it leaves us with a provocative thought for you, listening. What does that clash tell us? You've got executive profit-taking at the giants, high insider belief at the M&A engine despite weak numbers, and institutional skepticism towards that same engine. What does this dynamic suggest about the real odds of success for future media consolidation in this incredibly tough sector?
A great question to chew on. That divergence between insider action, executive action, and analyst views really paints a picture.
It certainly makes you think about where the different players see the value and the risk.
Fantastic insights pulled straight from the data. Thanks for walking us through that. And thank you for joining us on the deep dive. We'll see you next time.